Let's say something you won't hear on the 6 o'clock news. The U.S. housing market is running two different races on the same track. One side sprinting while the other stuck in quicksand. And whichever lane you choose in 2025 could decide your family's finances for the next decade. Sound dramatic? Good, because while headlines keep you yelling, housing slowdown, buyers in Raleigh and Nashville and parts of metro Atlanta are still writing offers the same day as those listings hit the MLS. Meanwhile, 2 hours down I-95, Jacksonville sellers are knocking 10, 15, even 30 grand off brand new builds just to keep traffic coming through that model home. If you're confused, you're not alone. Mortgage rates hover near 7%. Existing home sales are flirting with 30-year lows. Yet prices in dozens of markets, especially here in the Southeast, are at record highs. How do you square that circle? In this video today, you're going to hear straight from the CEOs of Lennar and KB Home about why they're slicing prices in Florida but holding firm in Las Vegas. We'll unpack the census data showing 2.8 million people pouring into the country, mostly settling in the very metros you and I drive through every single day. And I'll reveal the 42 markets where inventory is still less than half of what it was before COVID, meaning bidding wars in those zip codes might be the norm this spring, not the exception. By the end of this video, you'll know exactly why some neighborhoods feel ice cold while others feel white hot. Plus the practical moves you can make, whether you're a first-time home buyer, seasoned investor, or just nosy about your neighbor's estimate. Grab your coffee, buckle up, and let's get tactical. All right, let's start with the folks who literally pour the foundations, the public home builders. KB Home and Lennar both told Wall Street in late March that spring traffic looks healthy, but conversions, actually signed contracts, are softer than normal. Translation, buyers are kicking the tires, but only if the deal feels literally irresistible. They can't pass it up. KB's average sale price last quarter clocked in at about 500 grand, and they expect that number to slip another 10 to 20K by December. How are they making it happen? Two levers: base price cuts and mortgage rate buydowns. Picture a $500,000 house suddenly advertised at $485,000 plus a 5.25% interest rate, fixed. When everyone else is quoting 6.8, that combo is moving product, but it's also squeezing margins. KB's gross profit dipped from 21.6 to about 20% year over year. Regionally, Florida is the headache. Jacksonville's at 7 months of supply, 1 month above a balanced market, and Orlando's not far behind. So KB is shaving 5 to 30 grand off roughly 2/3 of their homes in Florida communities, just to find where the market settles. The flip side, Las Vegas is the cash cow, lowest incentives and highest margins. Why should you care? Because builder incentives often lead resale price trends by 3 to 6 months. If the production guys are blinking first in your zip code, resale sellers will follow. Usually after the next appraisal comes in a little light. Next up, the resale world. February seasonally adjusted annualized pace landed at 4.26 million sales. Pre-COVID, 2019, we were cruising at about 5.3 million. That's a 20% haircut, folks. And that's not just a blip. 2024 logged the fewest existing home deals since 1995. The culprit is a 1-2 punch, affordability and the lock-in effect. Rates jump from the 3s to the 7, while the median price keeps flirting with about $400,000. If you bought in 2021 at 2.9%, selling now means swapping into a payment that's often double. And that's before we talk about moving trucks, new furniture, kids switching schools. So would-be sellers sit tight. Inventory stays scarce, and buyers duke it out over whatever hits the market. Total listings are up roughly 28% year over year. It sounds great until you realize we're still 20% below March 2019. In the Southeast, it's even starker. Atlanta sits about 15% shy of 2019 inventory. Birmingham's closer to 25, yet both metros added jobs in the last 12 months. This mismatch keeps a floor under prices. For viewers thinking, I'll wait until prices crash, remember, low volume does not equal low prices. Until rates or unemployment break in a big way, expect a slow grind, not a cliff dive. People are on the move. Immigration, return to office, and the Sun Belt story. Let's zoom out to the migration chessboard. Between July 2023 and July 2024, the U.S. population grew by 3.3 million souls. 84% of that surge, net international migration. That's right, 2.8 million new neighbors, many headed straight for coastal gateways or major job hubs. Remember how New York City was hemorrhaging residents in 2021? Last year, that flipped to the largest population gain in the country, adding about 213,000 people. Los Angeles, Chicago, Boston, Seattle, same story. Those losses turned into modest gains. That matters because it reignites demand in markets that had cooled significantly. Rentals fill up, entry-level listings vanish, and suddenly those pandemic discounts in Brooklyn start evaporating. Now, for my Sun Belt listeners, the Southeast is still the growth champ, but the pace is normalizing. Atlanta, Tampa, and Dallas are gaining people, just not at the warp speed of 2020 and 2022. Some of those remote workers who landed in Nashville or Destin are quietly drifting back to the headquarters as return to office policies firm up. Meanwhile, first-generation immigrants often gravitate to those big metros with existing culture hubs. Think Houston, think Miami, and yes, New York as well. Further tilting demand back towards an urban core. So what's the play? If you're in the Sun Belt market that went vertical during the pandemic, expect steady, non-explosive appreciation. Investors banking on 15% annual gains are going to be hugely disappointed. On the other hand, urban rebound markets could surprise on the upside as inventory there is thinner than it looks once you adjust for this fresh new demand I just pointed out. Immigration is the stealth demand engine nobody is pricing in yet. I promised the 42 tightest markets where sellers still rule. Let's talk scarcity. Among the nation's 200 largest metros, 42 still have over 50% fewer active listings than in March of 2019. Picture a grocery store where half the shelves are empty. Prices don't exactly drop, do they? Most of these ultra-tight markets sit north of the Mason-Dixon. New Jersey, Connecticut, upstate New York, parts of Pennsylvania. Why so tight? Fewer new builds, older housing stock, and the owners clutching to those 3% mortgages like Super Bowl tickets. Bridgeport, Stanford is down almost 80% on inventory. Hartford's not far behind. Even Chicago, often painted as soft, sits roughly 60% below 2019. But the Southeast has its own pockets of pain. Raleigh, Durham, Charlotte, and Nashville hover near the 50% deficit line. These tech and healthcare magnets never saw a construction glut, and local zoning keeps new supply in check. Translation, bidding wars for anything turnkey under $500K. If you're a buyer eyeing these metros, prep your finances yesterday. Lean on a local agent who knows how to write an aggressive yet clean offer and be ready to waive non-essential contingencies. Sellers, price it right in the first weekend and you'll have leverage, but today's buyer is payment sensitive. Overshoot and they'll scroll right past your listing. All right, some action steps for Southeast buyers and sellers. Let's get tactical, especially for the Georgia, Florida, and Carolina crew. If you're buying new construction, leverage the builder's pain. Ask for closing costs, rate buydowns, or design center credit. Builders want velocity. A clean contract can unlock concessions worth tens and tens of thousands of dollars. Shopping resale, use the seasonality. Listings spike April through June, then fade. If you can hang tight until mid-July, tired sellers start trimming those prices before school resumes, but don't lowball blindly. Run comps with your agent to spot 2 or 3 listings priced 5% too high. Those are your targets. Sellers, remember, Buyers care about monthly payments, not sticker price. Offer a 2-1 buydown or a permanent rate subsidy. It costs you less than 10 grand price cut and widens your pool of qualified buyers. Stage the house, fix the obvious stuff, and photograph it professionally. Scroll stopping pics matter more than ever in an inventory light market. Investors hunting cash flow look beyond the hottest suburbs. Secondary markets like Huntsville, Alabama, or Greenville, South Carolina still benefit from the Sun Belt migration but trade at lower price to rent ratios. Bonus, Alabama's property taxes are about a quarter of what you'll pay in Metro Atlanta, so consider Alabama. Cap rates. They expanded when rates shot up, but sellers are now adjusting expectations. If you're underwriting a deal, stress test it at today's rates. Then sprinkle a little upside only if you can stomach a longer hold. And watch insurance. Coastal Florida premiums can eat your cash flow faster than anything that's out there right now. It will absolutely bust you. For appreciation plays, keep an eye on markets with tight inventory but improving job pipelines. Think about Chattanooga with Volkswagen expansion or Tampa with its life science boom. Those metros marry supply scarcity with wage growth, a combo that tends to outperform over a 5-year horizon. So what did we learn? Builders are trimming prices where they must. Existing home sales are stuck in neutral. Immigration is silently juicing demand, and 42 metros are still in an inventory chokehold. In other words, 2025 isn't a buyer's market or a seller's market. It's a market for somebody who has some strategy. If this breakdown helped you, smash that like button, hit subscribe, and ring the bell so you never miss a data-driven take again. I'm Darin Hunter, your mortgage guy here in downtown Woodstock, Georgia. I'll see you on the next one, and that's a guaranteed video.